Bob Huebscher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Investing in smart beta was the rage in the early 2000s as small cap value stocks vaulted over large cap growth stocks. But like all supercharged investment strategies, it didn't last. Factor premiums have not materialized since the financial crisis, and for most of the last decade, value has underperformed growth, driving the underperformance of the largest category of smart beta strategies. We'll go over the case for and against factors in this interview with long-term investment advisor Rick Ferri. Rick has been an investment advisor for 35 years and has embraced a low-cost Boglehead's investment philosophy for the past 25 years. He does not manage portfolios or sell investment products, although he has done both during his career. Today, he runs Ferri Investment Solutions, where he advises do-it-yourself individuals at an hourly rate. So, Rick, you and I have known each other for a long time, and I was really looking forward to speaking with you today. I have great respect for the work that you have done and for your investment philosophy. But let's start off by having you tell us about your career path. And I want to go back to your military career, which I know includes flying jet fighters off of aircraft carriers.
Bob, thank you for inviting me on your podcast. I know we've known each other a long time and greatly appreciate the following. As far as my career, I think that flying jets in the Marine Corps off aircraft carriers had a lot to do with how I ended up believing in this low cost indexing strategy, because I let the data drive the decision. And when you're coming aboard aircraft carriers, you have to believe your instruments. You have to believe what you're seeing. It's very precise. And it's the only way you're going to survive in that environment, in that very difficult environment sometimes. I brought that over to the investment world when I left active duty back in 1988 and believed that Wall Street may act the same way, and found out that pretty quickly that that wasn't the case. There was there was very little accountability for market calls or for stock market calls or for the fact that a lot of the managers that were managing money underperformed. And what was driving a lot of the advice was yield to Wall Street rather than yield to the client. And this over time drove me to find out about index investing. It was later in the mid 1990s when I discovered index investing and ETFs. I was one of the first brokers. I was working at a brokerage firm at the time to begin using spiders, S&P 500 ETFs, and middies, S&P 400 midcap ETFs in my clients' accounts, which did not make my company happy because there was very little fee in that to us. We basically got a commission. So after being in the investment industry and the brokerage side, sell side for say 10 years, I decided to start my own small money management company where I would charge clients a very low fee. I only charged 0.25% management fee, AUM, but I put clients into index funds, Vanguard index funds, some ETFs at the time that were available. And I used a little bit of the DFA funds because they did have this factor exposure, which I was interested in. And that's how I ran my business until about 2018 when I was bought out. And now I just do an hourly model to help individuals who are managing their own portfolios, help them with their investment portfolio. So that's a brief history of where I came from.
Wonderful. Well, and thank you for your service. We're going to start off by defining what we mean by smart beta, which is our topic for today. In my view, it includes rules-based strategies that seek to identify top performing stocks, although it could apply to bonds as well, based on historical data using typically some sort of regression analysis, but that doesn't necessarily have to be the case. But the idea is that you're going to re-weight or weight differently the universe of stocks to favor stocks that have certain characteristics. And the most common strategy is to buy what are called value stocks, which might have a lower PE or a lower price to book ratio or some other metric that makes it look cheap. Is that consistent with your thinking?
That's a very consistent with what is attempting to happen here. Let's talk about it in terms of factor investing rather than smart beta. Smart beta became the marketing term for this because beta, you could say, is simply the return of that factor. So those are betas, which are regressions. And so somebody decided, oh, this is smart beta because it gives you a, at least historically in back testing, had given you a excess return called a factor premium. So you've got the main factor out there is beta, which is simply the risk and return of the market as a whole. And beta explains more than 80% of the return of any diversified portfolio. So if you go out to randomly select 100 stocks, 80% or more of the return of that randomly selected stock portfolio would be just the return of the market. And the rest of the return of that portfolio would be based on what you described as a smart beta, which would be additional factors. And I use the word additional factors because that's what Gene Fama, Nobel laureate Gene Fama, called them, which are the size of the companies in that portfolio relative to the market portfolio, the percentage of value stocks in that portfolio relative to growth stocks. And then there's others like quality of the companies and price momentum and so forth. And these additional factors made up about 20% of the variability of any diversified portfolio. So most of the return of any portfolio is still the market. But the variability beyond that can be attributed mostly to these additional factors. Now, sometimes those factors are positive and sometimes negative.
This has not been a, or the past decade has not been kind to factor investing, in particular to value investors. Value has significantly underperformed growth over the last decade. Why did smart beta factor investing do so poorly?
I think there's a lot of explanations, but as far as value versus growth, we had a period of time after the financial crisis where interest rates went down to 0%. In fact, real rates were negative. When that happens, it favors growth stocks because it makes the income stream from growth stocks, the earning stream, more valuable, especially with growth stocks where the earnings are growing more rapidly than in value companies. So when you discount those earnings at a smaller and smaller and smaller number, the value gets larger and larger and larger. So we had a period of time from, say, 2008 through 2021 where we had these very low interest rates, and this just favored growth stocks. So I think that was the fundamental explanation of why growth outperformed value. But I think there might be another explanation, and that is that after the tech wreck in 2000 to 2007, right before the financial crisis, we had a fantastic run up in small cap value stocks, and that attracted a whole lot of money. And that's when this term smart beta was formed. And companies such as DFA became famous, if you will, and advisors were clamoring to put money in DFA funds. And there might have been way too much money going into those uh, stocks. And, that could have explained part of the underperformance that occurred, the regression to the mean, if you will, that occurred over the last 15 years. So that, to me, is another explanation, although I think weaker than the fact that interest rates went down.
Do you think part of it lies in the fact that the typical smart beta factor strategies use basically a fixed percentage of the universe that they're going to select. So they might choose the cheapest 30% of stocks based on whatever metric, price to earnings or price to book that they're using. And at any given point in time, the actual percentage that are cheap might only be 10% or 15%, or maybe sometimes it's 40%. But to focus or to restrict yourself to a fixed percentage is very limiting.
Providers of factor funds have their own methodology for determining what is small cap, what is value, what's quality. They're fairly similar when you're looking at size cuts. What is large cap, what is mid cap, what is small cap. That's fairly similar. And the dispersion of returns around large cap funds and mid cap funds and small cap funds is very, very similar. So the dispersion is fairly tight. But when you get to something like value, you've got all kinds of beliefs about what value is. As you said, price to book, price to earnings, enterprise value, return on equity. Value is in the eyes of the beholder. So you get a much wider dispersion of return on value because everybody has a different definition of what it is. When value does poorly, all the strategies do poorly, although they do poorly to varying degrees. And that is all based upon the index provider or sometimes the fund provider, if they're doing self-indexing or active management, how they make a determination as to what they're going to have in their portfolio. Now, to your point, yes, if you're using an index, you are restricted to what's in the index. At least 80% of your portfolio has to be what's in the index. So you can't call yourself an index fund or an index tracking fund. So to the extent that the index is not as valuey as, say, the bottom 10%, then it would have an effect. Now, there are some factor funds that weight based on value loads how valuey a company is rather than cap weighting. So that seems to overcome some of the bias that you spoke of, where you're digging down there, but you're not really digging down far enough.
I want to get a sense for how strongly you feel about this. I remember in 2014, I wrote an article based on a talk that Bill Sharp gave, another Nobel laureate. And the quote from him that stood out was, "Smart beta makes me sick." And that article, it turned out to be one of the most widely read articles ever on our site. Do you agree with that sentiment? Is it still smart to invest in smart beta?
Well, first of all, I don't use the term smart beta, so it 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 it's neither smart nor dumb to do it because there's no dumb beta. Therefore, there's no smart beta. It's a marketing term. It sure sounds good to people who don't know any better, right? But it's not. It's just additional factors. The idea is you're taking more risk when you invest in small cap value stocks because they're not growing as much. Their balance sheets aren't as strong. The idea from a French viewpoint is that there is more risk when you invest in these stocks. And I think that the best analogy that I came up with is the difference between investing, say, in a AAA rated corporate bond and a B rated corporate bond. So a AAA rated corporate bond, you would expect to get a certain return from that because it's a high quality bond. The B rated corporate bond, you would expect to get more rate of return because it's a lower rated corporate bond. And you could do the same thing in the stock market. You could look at all these companies, you can list them out, and you can say which ones have higher risk, a business risk than others. And the ones that have higher business risk should give you a higher rate of return in the long term. So I don't think it's anything much more different than that. If you add more of these stocks, these riskier stocks to your portfolio, you should theoretically get a higher rate of return in the long term. I think that's the right way to look at it. And that is the way I look at it, by the way. So if you're willing to take a little more risk in your portfolio with some factor funds in your portfolio, then you should be expecting to get a higher rate of return. But sometimes you pay for that in the form of negative tracking error. And sometimes that negative tracking error to the market lasts a very long time. It adds another element of risk that we'll get into, and that is behavioral risk during those periods of time.
I'm going to ask you about behavioral risk, but just to make sure we're on the same page here, when you talk about the fact that clients are taking on more risk when they take on one of these factor strategies, the risk that you're talking about is volatility.
In negative tracking error to the market. I mean, they will, the stocks may not have any more volatility than the market, but they underperform the market. So you're looking at your account and it's just not going up as value with the rest of the market. If you had a total stock market fund and you had a small cap value fund, the small cap value fund is underperforming. It may not be more volatile, price volatile, but it's just underperforming.
What do you tell clients who have underperformed for more than a decade?
Well, if they're still in small cap value, I tell them they got to stay the course. They need to hold on to it. You made the decision to get into it 10 years ago. You've underperformed for 10 years. If you sold now and you took your position off, you will lock in that underperformance. So, this type of investing takes about 25 years. So, this is a conversation I had with Wes Gray, who is the CEO of Alpha Architect and a University of Chicago PhD who has studied this. And we were just discussing how long does a uh, how long does a factor investor need to invest in order to have a high probability that that factor will produce a positive premium? In other words, they'll outperform. And we came up with about 25 years. It's only been 10, or for that particular client that you're speaking of. And so I tell them, you're going to have to stay in there for another 15 years. And if you sell now, you're locking in your underperformance and you'll never get it back if you were to sell and go to, say, a total market index fund. So you made the decision to do this 10 years ago. I recommend you stick it out.
25 years is the length of the accumulation phase for many people in the workforce.
Yeah, I know. Uh, I call it a lifelong investment strategy, and sometimes even that isn't long enough.
What about a new client? Someone who comes to you today who's just beginning the accumulation phase in their work careers?
Okay, so I do an hourly model, and I'm a big advocate of just do your beta investing first. Decide how much to have in equity, how much to have in bonds, how much to have in real estate, how much to have in cash, and beta is going to drive wealth accumulation in addition to how much you save, of course, over your lifetime. These side bets, like should I have small cap value or not, I don't bring it up with clients unless they bring it up. So if they bring it up and say to me, what do you think of factor investing? What do you think of adding some small cap value? I've read about it, I've heard about it. I ask them, tell me what you know about it, and let them explain to me why they think, let them convince me why they should have it. And if they know enough about it, and I think that's really critical because you really have to understand this stuff to do it. Remember, I'm dealing with investors who are going to self-manage their own portfolios. They don't have an advisor who's going to manage their portfolios. They're self-managing. So they have to stay the course. And if they can convince me that they are going to stay the course, then we'll talk about an allocation to small cap value. And that would be no more than 25% of their equity portfolio. But, we'll talk about some different funds and what they should add, how much they should add, where they should put it, what type of an account they should put it in, whether it's tax deferred or tax free or taxable. That's very rare. I have to say, maybe one in of my clients who are new or just getting started with investing bring it up. Most of them don't. Most of them don't care about it. They just want to get their beta allocation correct and go to work, make money, save money, let the markets take care of the rest.
You're okay with adding up to 25% to small cap value. How do you think more broadly about additional factor risks? How much is appropriate?
Well, the 25% would be the total additional factor risk. How you go about doing that can be just small cap value. It could also be a multi-factor fund, which does small value, momentum, quality, all in one, all rolled into one. And a lot of the fund companies do that. And so you're not getting, the deepest small cap value because you want an element of quality in there, maybe an element of momentum. So companies like DFA, Avantis, even I believe in Vanguard might use this. So it is I just prefer to use a multi-factor fund rather than a individual small value fund, then an individual quality fund, then an individual momentum fund. I mean, that gets way too complicated.
We talked about tracking error risk. We've talked about volatility. We've talked about the behavioral risks, getting clients to stick with a strategy long enough for it to succeed. Are there other risks that we haven't talked about relative to factor investing?
Well, there's something called factor decay, which I did hit upon. All of the data from the academics, and there are many, many studies on various factors. There's something out there called the factor zoo, that 300 different factors have been identified as having a factor, a premium at one point or another. So there's a lot of academic data out there. But the thing about the academic data is, of course, it's all back tested. I mean, we didn't know these factors actually existed until we go back into the data, perhaps back to the 1920s, and crunch the data all kinds of different ways until, torture the data until it confesses that, oh, look, if you would have invested this way, if you would have gone long small value stocks and short large cap growth stocks, you would have had this huge small cap value premium. And that's great, except that it didn't happen. I mean, nobody knew that back then. And this was only discovered in the more or less the early 1990s. So if people knew that all these factors produce big risk premiums back in the 1950s and 1960s, would it have changed the size of the factor premiums? I argue it would have. It would have. So we're looking at a period of time when nobody knew these things existed. There was no money being allocated to those strategies. Now, there's a lot of money being allocated to those strategies. And is this affecting the factor premiums? Are we getting what's called factor decay? I argue that we probably are. How much factor decay? Well, some people have said 50%. I mean, if you look at the data on small cap, when small cap was discovered, and the first paper written about it in the early 1980s, could have been 1979, it hasn't happened since. And then when Gene Fama and Ken French came out with their three-factor model and talked about small cap value investing, it's debatable whether most people who did it have benefited from it. I'm not talking about whether the data says that it actually happened. I'm talking about by the time people got into it, which was in the 2002 to 2007 timeframe, when advisors, if you were in the business like I were getting inundated with phone calls saying, "How do I get DFA funds?" If in aggregate investors actually benefited from factor investing, I would argue no one has benefited from factor investing except the people who create the products for factor investing. So if you want to do it and you're willing to be in it for 25 years and you buy a cheap enough fund that has enough factor loads in it, enough intensity of the factors in that fund that you're buying, and you limit it to 20 to 25% of your portfolio. If this is what you want to do and you're going to stay the course for 25 years, then if that's what you want to do, that's fine. Let's talk about how you would do that. Other than that, I don't get into it. It's not needed. It really isn't needed to meet your financial objectives. And by the way, advisors have a lot of business risk if they're pushing this. They're trying to push some sort of alpha seeking strategy by doing factor investing. And I think that's business risk because if you're wrong, clients may not stick around and may go somewhere else. So there's business risk in doing this.
And you don't have that business risk when all you promise is market equal returns through a cap weighted index fund. Rick, you're very involved in the Boglehead organization. I'm wondering, first of all, maybe tell our listeners a little bit what the Boglehead organization is, but more importantly, I'm interested if you ever spoke with Jack Bogle about factor investing, and what do you think he would say now about factor investing?
Okay, so the Bogleheads are An organization that was formed online, first on morningstar.com, and then we have our own website, bogleheads.org. It's driven by a nonprofit organization called the John C. Bogle Center for Financial Literacy, and a 501c3 nonprofit organization. And it's basically investors helping investors understand how to invest, making the world a better place for mostly do it yourself investors, although we have a lot of advisors who are Bogleheads, a surprisingly high number of advisors who are Bogleheads and follow the same ideals that I talked about. Just buy beta, don't make it complicated. And we just had our conference. I just came back yesterday from our conference. It was our 21st conference, second one after Jack Bogle died. But he always came to the conference prior to him passing. And we had 500 people in Bethesda, Maryland. And next year we're going to have it in Minneapolis, Minnesota, around the same time. There's a great interest in this out there for people who want to learn and want to do things right. And so it's a wonderful organization. As far as Jack Bogle, he was never a fan, never a fan of growth and value investing. There was one conference we had where Larry was there, Larry Swedroe. Larry's a good guy, very smart guy, does a lot of research, and I really like Larry's research. I don't agree with actually the implementation of a lot of it, but he really is very good at doing research and vetting it out. But he was up there talking about how value investing and small cap value was the place to be, and this was in the middle of the heyday of value, and back between almost 2003, 2004, something like that. And then Jack got up and just blew it away. He showed, well, let's look at this value versus growth thing. And he showed all the slides of the actual funds, not the theory, the actual value funds that had been out there in the marketplace for a few decades relative to the growth funds, relative to the market. And it was interesting because the funds did not produce the premiums that Larry was talking about. So he's never been a believer in doing the factor tilting. And I'm sure today he would not say, I'm going to change my mind. He wasn't the type of person to change his mind anyway, but I'm pretty sure that he wouldn't have changed his mind. He's a total stock market investor.
Larry Swedroe is one of our more widely read authors on advisor perspectives. He and I have had more than a few discussions about the merits of factor-based investing. Rick, if there's one key takeaway that you'd like to leave with our audience of advisors about the questions they should ask before allocating to a factor-based strategy, what would that be?
Ask your client whether they would want this or not. It's not something that I believe is a good idea for advisors to say, this is how we manage money. We use factor investing. We take small value tilts. We do a slice and dice strategy. I mean, don't use complexity for job security. This is a complex way of investing. And I have a saying, complexity is job security. Don't use complexity as job security. Use your own ability to help the client through many financial situations. You don't need a complex investment portfolio. You're not going to get fired just because you have just beta in your portfolio. I know that. I used to tell my clients, even when I had some small cap value in their portfolio, look, I mean, even if this thing does outperform, it maybe will produce enough to pay our fee, but in the end, you're going to get beta. So you could go out and do it yourself and get beta, or get the return of the markets, or you can hire us. We're going to put a little bit of this factor stuff in your portfolio. If we think it might outperform by in the portfolio in aggregate, maybe 25 or 30 basis points, but that's our fee. So we get that, and you get beta. Now, the reason you're hiring us isn't because you think we're going to beat the market. You're hiring us because we provide a service. We manage the portfolio because you don't want to. Or maybe you don't trust yourself that when the market goes down, you're going to stay the course. So you'd rather have somebody else do it for you. That's why, you exist. That's why we existed. It wasn't to make complex portfolios to outperform the market. It was to provide a service and keep the client on course. And so I think this stuff is oversold, and it's sold for the wrong reasons. I just say you don't really need to do that as an advisor to be successful and to help your clients.
Rick, thank you very much. We're going to include a couple of links in the notes that accompany this podcast. There'll be a link to a presentation that Rick just gave at that Boglehead conference. That presentation is called The Case Against Factor Investing, and we'll also include a link to Rick's firm, Ferri Investment Solutions. Rick, is there anything else you'd like to add?
Well, I want to thank Advisor Perspectives and Vetify for having me on the podcast. So it's been wonderful to talk with you again, Bob.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Huebscher, today featuring Rick Ferri of Ferri Investment Solutions. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.